Gold continues to reach fresh record highs, with global demand amassing $100 billion in value, according to the latest World Gold Council report. But with an election in just days, can gold continue to push higher, or will a potential Trump victory pull it from its pedestal? For more, Ingrid Willinge spoke with Reade, market strategist at the World Gold Council.
The thing that needs to continue to shift is we need to see more Western investment demand for gold. The last few years has really been dominated by emerging market buying of gold, whether that's emerging market central banks, emerging market jewellery, bar and coin investment. But there's signs of all of those categories beginning to slow down a bit. What's been missing from gold has been Western demand. Now, this quarter's seen investors with exchange-traded funds adding to their holdings, so that's a positive start. But the physical coin and small investment bar market in the West still remains quiet. We need to see that improve for gold to trade higher, I think, sustainably.
All right, we're going to talk a bit more about that shortly, but I want to get into the US election impacts because, of course, it's coming up next week. It's a big catalyst, I guess, at least in the short term. Do you expect to see gold move? At the moment, the polls are predicting a Trump victory. How would you expect gold to react to that initially?
I mean, it's very difficult to say. There's decent indications, I think, that as the chances of a Trump victory have improved through October, we've seen this combination of the US dollar being strong, Treasury yields heading higher, and gold prices going up, which is really an unusual combination of factors. I think all of them are reacting to the potential or the increased potential of a Trump victory. I think the nature of the victory is really important. If Trump wins the presidency and if the Republicans get control of Congress, then that's probably a more positive outcome for gold because deficits tend to be wider when the president and Congress are from the same party. There is the risk, of course, though, that we get a volatility event, a risk-off event in markets. If financial markets, take the results or maybe the process of securing the result badly, then we could be in a situation where investors sell all assets. And we've seen this before after the failure of Lehman Brothers during the GFC or in the early stages of COVID. There is the potential for gold to fall initially with everything else. It doesn't stop it from going up afterwards, but there is always a risk that in one of these sell everything moments, gold can get hurt too.
Which is hard because often gold is the safe haven, right? Isn't that where people tend to flock in a risk-off environment? Eventually.
But if you're sitting with a situation where there's lots of leveraged long positions, which we can see on the US futures market, sometimes what people need to do is sell everything or a lot of what they own to reduce their position sizes, and that can hurt gold in the short term. Short term being a week or two sometimes.
Yeah, okay, because it's interesting because, as you mentioned there, gold has somewhat defied these headwinds around the stronger US dollar, and higher rates, and this is predominantly because of emerging markets.
Yes.
So is that something that you're expecting to continue? I know you say you need the Western investment as well for it to go higher, but do you expect EM demand to continue?
A lot of EM demand I would expect to continue. We're going to see, we expect, more central bank buying at the higher rates we've got used to over the last few years. We probably will see more investment demand for gold as well out of the emerging markets, but high gold prices are hurting jewellery demand. And we've seen that in our numbers last quarter and this quarter. When the gold price goes up rapidly, the jewellery market stands back from it.
It's hard to imagine, though, that the gold price will go higher. I think there's been 30 record price highs in 2024, it said in your report. Is it not getting overvalued at these levels? Do you think those Western investors will come off the sidelines at these levels as rates start to come down?
Yeah, I mean, it is a key test. But then again, if you look at other markets, they're at all-time highs, and it doesn't stop investors keeping buying there. I mean, I can say quite categorically that the gold price is too high for some jewellery buyers. But so far, there's no indications that it's too high for investment buyers. And as I say, the positive global inflows that we've seen into ETFs, that's the first time in 3 years that we've seen that in a quarter.
Well, interesting you talk about that, because I want to just hear the dynamics around this, the gold ETFs versus bar and coin demand. Can you just talk us through the dynamics of those?
Yeah, I mean, the good thing about gold is you can buy it in many different forms. ETFs, which launched 20 years ago, have been very popular. They're ideal investment vehicles for people who have brokerage accounts and are used to buying shares. They can buy ETFs in gold as well, very simply. Bar and coin demand, which has obviously been around a lot longer, tends to be for a different type of investor, perhaps one not quite as financially sophisticated, and certainly for one that doesn't trust the financial system to the same degree. If you're worried about banks going under, you probably don't want to trade stocks and shares through a brokerage account. You'd rather have a physical, tangible asset that you can have in your hand. But there are costs to that. If you're going to buy physical gold, you are going to pay a premium over the gold price that we all see on our screens. So it's different horses for different courses, really.
But do they tend to be correlated somewhat?
Somewhat. Retail buying of ETF demand is pretty correlated with bar and coin demand within a market. But then there's also institutional investors and hedge funds that play ETFs as well. And they can sometimes be operating in different directions to what the retail space is doing.
Have you seen an increase in Australian ETFs for gold? I know they've been increasing in demand, I think it said in your report. Is this something you've discussed? I know you've been at the International Mining and Resources Conference. Has this been a big sort of thematic?
We've focused more on the global flows. But what I can say is if we look at the demand numbers that have come out of Australia in the last quarter, they're very consistent with what we're seeing in the rest of the Western world. So jewellery demand down a bit and an ETF flows positive. So I mean, Australia is an important market for gold. It's not one of the largest, but it's certainly important. It's behaving in line with what we're seeing in the United States and to a lesser extent Europe.
AI, I've got to mention AI. We talk about it almost every day across everything, but it's been, huge for markets, but also pushing up demand for gold, hasn't it? Just talk us through how AI and technology, because it's not something that you ordinarily would relate to the gold space.
No, it's not. And that's because it's not the biggest component of gold demand. It represents 7 or 8% of demand in the technology space or industrial demand for gold. But it's absolutely vital. As I say to people, all the electronic gadgets around this room have got gold in them, in their microprocessors. And if we didn't have gold, we'd have to use lesser metals like silver or copper. They would be bigger, they'd be heavier, they would break more frequently.
Just cheaper.
But they would be cheaper. Nobody uses something trading at $2,800 an ounce when they could use something trading at $35 an ounce by accident. But what we are finding is that the AI boom, the demand for AI chips and everything associated with that, the fact that we'll have to upgrade all our laptops and mobile phones repeatedly over the next few years is benefiting technology demand for gold.
OK, before we go, I want to talk 2025. Once the election's in the rearview mirror, we've got, that risk at least out of the way. What is expected to be driving gold over the next 12 to 18 months?
Probably the biggest factor is going to be declining interest rates in the West. We have seen the beginnings of an interest rate cutting cycle in Europe, North America. As the economies are still doing okay in North America at least, less so in Europe, but rates still do look too high on a medium-term perspective. And generally speaking, when rates come lower, that's a good tailwind for gold. There'll be lots of other factors as well that play a role, but that's probably the biggest thing that we're keeping our eye on is the interest rate cycle.
John, a pleasure to have you on the program. Thank you so much for making time for us today.
Thank you very much for the conversation.